Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul, what's going on, bud?
What's up, man?
Nothing. We were just making some jokes before I hit the record button, so.
Yeah, like right before.
Right before. Yeah, I like to do that. What have you been up to?
Nothing. Just had my last day of work. I went into the city today and did my Army duty, and tomorrow
Just
I'm going
for
on
the week,
leave.
right? For the week.
Yeah. Oh, yeah. So I'm going on leave tomorrow, and we're driving up to Connecticut to stay with to one of Tammy's friends and see some of her family up there. So,
All right. Well, yeah, I was excited there for a second because I thought you'd retired. You said it was your last day of work, so.
Oh, yeah. No, unfortunately, it's not. But if they keep going with this nonsense they keep throwing out, this is local stuff. I will retire.
Yep. We'll do it. I'll be waiting on the other side for you.
It's getting annoying.
Yeah. I went in, you see, I had to shave this weekend. It's
You have drill?
Yeah, I had drill. It's never enjoyable to shave. I don't like the way I look when you look in the mirror after you have facial hair all the time and then you shave, and yeah, it's a weird sight.
You look younger though.
I know, right? I don't know. I don't know how much younger I want to look, but thank you.
Well, you'd have to. Well, never mind.
All right, man. Well, what are we talking about today? Hey, we got a question we want to start with. So you and I were discussing this beforehand that we've got a shared client, actually somebody who came in through the podcast, and I'm taking this client, to the finish line, and one of them, she said, "Hey, now that this policy is approved and all that, and I know all about infinite banking, I've also got a convertible term policy with this other, small, local insurance company. And I think I already set up a time with my agent to go, talk about converting that to a whole life policy a couple weeks from now." And so I just wrote her a couple things back and I said, let's talk next week, because the point of this is just because you have a convertible term policy doesn't mean converting it to a whole life is your best play, right?
Yes.
There's some good reasons to do it, and then there's some great reasons not to do it. So what do you say to that?
Yeah, first and foremost, that's great that they bought that product whenever they did buy it, because it does have value, right? And for a reminder, folks, convertible term is a type of term policy that has a provision in it to change part or all of the death benefit into whole life without showing without going through additional medical underwriting, right? So it's what we sell and what we provide for clients that can't afford whole life premiums yet, and it has tremendous value in that sense. But I will say this, Dave, I agree with you, because what company is it with? Is it a
Right.
mutual life insurance company, or is it a stock company that that does not likely pay dividends to its policy holders? And if this person in this case just got underwritten for insurance through very conservative underwriting and is approved, well, just how much do you want to convert? Let's build that into the policy that you just got approved for. I think that
Right.
would be a better move.
Yep, exactly.
That is a better move. It's not.
No,
I think
it's
it is.
absolutely a better move. I think some people think of it as, well, I've already been putting money into this policy, so it only
Right.
makes sense to convert that. When, if you understand what term life insurance is, it's a sunk cost. Every month you make that payment, that premium payment, it's
The
a
money's
sunk cost. It's
gone.
gone forever.
Yep.
Right? So there's no benefit to converting that just because it's already in place, unless you're uninsurable,
Right.
which is what I recommend anytime you get convertible life insurance. Why would you ever convert if you're still insurable? I recommend, if you're still the same health as when you got that policy in place, instead of converting it, just go apply for a brand new policy from scratch and keep that convertible term in your hip pocket to convert later if you become uninsurable. Because if you can convert all of your convertible term into a whole life, great. But then you become uninsurable. You don't have any more options to get another policy on yourself.
Right.
So just
Yeah,
keep it in a hip pocket plan.
I think for a lot of people that probably makes a lot of sense. You and I have talked about this. Tammy and I have a convertible term on her that we've been slowly converting, but it's a massive amount of convertible term.
Yeah, if you've tapped out your human life value,
right?
Like you don't really have another choice but to convert because there's no more room to get another policy.
That's exactly right. So spot on, and that's what we're doing. And but at our age now, and with the new 7702 rules, it's taking it takes a massive amount of premium to convert that much death benefit into whole life.
Yeah.
Which is a good problem. When you're an IBC guy, it's a great problem. I've got room to put more and more money. Perfect.
Absolutely.
So yeah, sage advice. I like it.
All right. Wait, today we're going to talk about some IBC mistakes to avoid. So these could be for the newbie who's just learning about or hasn't yet gotten started with IBC. You can avoid these mistakes before going down that path. And for people who have already gotten started with IBC and the mistakes that we see some people continue to make, mostly for a lack of education or, lack of awareness. So I think the key point we want to drive is the value of infinite banking is in is not in the scene. The value of infinite banking is not what you see, it's what you don't see. And that's the entire process of banking, right? Controlling the banking function in your life.
Yep. And, what do we see as new clients? We see, and if we're working with some agents out there in the world that they can't get the illustration in front of you fast enough, well, that becomes the scene. I can see the numbers on page 10 and page 11 and page 12 of how much premium I'm paying, the cumulative premium I've paid over the years, when the premium and the cash value meet, whatever year that is. That's the scene that is part of the scene of what Dave is talking about. And people get so wrapped up in the numbers on the page. What I tell them, Dave, is this: look at all of this accumulated financial value that you'll have access to. The unseen becomes, what have you done with that over the 30 or 40 or 50 or 60 years that you're going to own this contract possibly? What have you done with that money? That's the unseen. And of course the unknown, because the future is unknown. But
yeah, the unseen is the many opportunities that will come your way when you're well capitalized. And what will those opportunities be? And you have no idea. You have no idea, but one thing we can guarantee is that there will be opportunities.
Yep. Opportunities abound. And I stole this from Ryan, for the well capitalized. I think it's the perfect way to say it.
Yep. Indeed. So here's one of the first mistakes that we see with people who become clients. And then something a lot of people fall into is leaving yourself on an island without a coach. So either somebody maybe had some agent set up a quote unquote IBC style policy for them, and then they never heard from that agent again, right? Or maybe they called the company and the agent went to a different company and now it doesn't even work there.
Very common.
Yeah, very common. With many companies out there. It wouldn't be that case with an IBC practitioner, most likely, in general, right? But there's some people who they get these policies, they're all jazzed about it, and they're full up, and they want to run with it, and they got their policy in place, and then the years go by, and they don't do anything, and it's a perishable knowledge that they had. But now they no longer have that knowledge, and they're wondering, well, I'm not doing anything with this policy. What should I be doing? And they don't have anybody to talk to because they haven't surrounded themselves with other users, and they don't have a good coach.
Right. I think. Wow, did you see that? I think John and John called it IBC amnesia in one of their recent episodes.
Yeah.
And I think that's perfect. Where I find myself not getting the amnesia. I'm past that point, but just I go back to Nelson's book all the time and just reinforce what I already know, but I just pick up a section of the book and reread it, and it really does reinforce, what we're doing. So I would highly encourage that surround yourself, and this is where I liked, these client only events that some people are starting to do now, where people come from all over the country to have a day or two of client only events where they are around people just like them, people that are paying high premium relative to their income, people that are successful in whatever business that they're in, whether they're a highly paid employee, whether they're a profitable business owner or whatever, but you're around people that think just like you and are doing what you are doing. And I think that's immensely important, especially when you're new and you're the only person doing IBC other than Paul or Dave.
Right. We hear that all the time. Like I'm working with one guy and he's like, I'm the only person I know. And I tell my family and they think I'm crazy, or, I tell my friends and they think I'm selling insurance to them. And he's not even licensed. So he's just excited about it, wants to tell people.
Yeah.
So, yeah. Okay, good. Well, how about this one? Stealing the peas. So that's a phrase we've used many times on this show, and it's one that Nelson references in his 92-page book. Stealing the peas. So I was talking to a prospect today and explaining that concept to him that, hey, you could, put your money here first, then you take a loan to go pay off that credit card debt that's charging you 20%. And now every month, that payment that was going to the credit card company, now instead you make that payment back to yourself. But here's the problem. The life insurance company doesn't require you to make that payment every month. Not like the credit card company does, or else they ding your credit and they sick collectors on you. So people have a tendency to steal the peas, rob from their own bank and not pay it back. So you have to put a system in place where you have a payback plan to restore that money that you borrowed from your own bank.
That's right. In short, right, you would never take a loan from the life insurance company collateralizing your cash value if you hadn't made provisions to pay it back, whether that's an amortized schedule that you make yourself, or you're going to have some sort of windfall 6-12 months down the road, in which case you pay back the loan in that sense. But again, it's just like a loan from a bank. You would never get a loan from a bank unless the banker thought you could pay it back, right? This is no different. But you're the banker, right? So you have to play honest banker with yourself. So yeah, spot on. I had a client that stole some peas, and I just go in there and check once in a while on the back side of the business here and just see. I was like, I noticed, send a quick text. Hey, I noticed you stopped making your weekly, $500 policy loan repayment. What's going on? And she's like, you know what, Paul? I've been stealing the peas, and I need to get back. I need to get back to it. And she did. I go back in there, and there it is, $1,000 a month going back against the policy loan. So
nice,
super important.
General reminder.
Yep. There
you go. And that brings me to another one we didn't even write here in our notes, but here's a big mistake that I'm always surprised that people make this, because I thought they knew better, but it just goes back to IBC amnesia. You kind of forget, if you're not using it, monthly or a few times a year, you kind of forget, where people have an outstanding loan and yet they're still saving money in a bank.
Right. You had a guy doing that, right?
Yeah. Or I've got $5,000 in my savings account, but I'm saving that up for something. Well, you have a $10,000 loan out. Pay it back. Put that $5,000 back into your policy. It's liquid. It's there for you. And then you're not paying interest on that $5,000. Oh, yeah, you're right. So that's just a reminder to people. You've built the best savings account you could ever find. Use it.
That's right. Nelson avoided using the term loans in the book because he says this, right? He wanted to demonstrate that you could do it using dividends to pay the premium eventually and all that, right? Because he says when people hear the word loan, they go into like mental paralysis, right? Their brain shuts down. They're like, I'm trying to get out of the loan business, right? I want to, and we've talked about that in past episodes of how the policy loan feature works. But yes, of course you would. Why? If you have excess money and you have excess policy loans, put that excess money against those policy loans every time.
100% of it goes towards principal.
That's right. And if you need that money, yep, it's going to be available again 2 weeks later. Take it right back out if you had to.
Exactly.
So.
Okay, how about this one? This is probably the worst one for people to fall for. The biggest mistake to make that keeps people from doing IBC properly is they limit the amount of wealth they can create by getting policies that they can only fund for 10 or 20 years, like a 10 pay or a 20 pay, because the idea of funding for 30, 40, 50, 60 years scares them, right? So what are they missing there?
Well, or they don't know any better. So I have a new client that has a policy with one of the big four, and he was a referral of a referral, so it's kind of cool. And we were talking about his policy, and he's like, "Yeah, I can pay high premium for the first 10 years, and then that's it." And I said, "So it sounds like you have a 10 pay policy or something." But anyway, long story short, he was able to go back after we had this talk about proper structure, and that term gets tossed around a lot. But proper structure to me is adequate base premium, and the ability to pay high premium for a long period of time, especially if this guy's in his 30s.
The contractual right, but not the obligation.
That's right. And that's what I want. I want to be able to pay premium as long as possible.
And why, Paul, what is so great about paying premium for, in year 30?
Well, that's the policy's going to, every year the policy gets more efficient. So why wouldn't I want to keep adding to that efficiency and benefiting from it? So in year 30, every dollar in premium could be producing 3 times that in cash value. It's like, hey, Dave, if you give me, 10 grand, I'll give you 30. Like, you're never going to stop doing that.
Right.
Unless you're foolish.
You're a car guy, so maybe you could create an analogy here, because I'm not a car guy. But I know it takes a lot more energy to get a car up to 70 miles an hour. But once it's at 70 miles an hour, you could remove some of the cylinders from that car, right? Like deactivate them, and it can run on, like, how many horsepower does it take to maintain 70 miles an hour? Right.
So the Hellcat tells me that it's got like a horsepower and torque thing. I'll have to go next time I drive it in the springtime, because she's put to bed now, because it's cold and wintry. But yes, you're absolutely right. So torque, the torque forces kind of get you going, and then the horsepower kind of keeps you going in a sense. But certainly it takes way less power to cruise at 60 miles an hour than it would getting there. You're using more energy.
Yeah.
For 100%.
And I would equate the premium to fuel. Like, once you've gotten it to 60 or 70 miles an hour, it only requires a little bit of fuel to to go the same distance.
Yes.
As opposed to the massive amount of fuel it took you to get up to that speed and that distance to travel, right? So why would you not want to have the contractual right to continue putting fuel in the fuel tank? You're just going to let it run dry, and then it's just going to coast and slow down. And
it's going to fizzle out.
Right? And then you're going to have to go get a new car and get back up to speed again if you want another place to put your money or put your fuel.
Yeah, absolutely. So long story short, he was able to go back and restructure that policy because it was less than 6 months ago, which is great. And he was uber thankful. And I'm not, and now we're moving forward with policies for his wife and his newborn son. But it was just a nice thing to have the knowledge to be able to tell him, like, yeah, man, why would you want to how did Trent put it? Purposely limit the amount of wealth that you can create.
Yeah. Is it your intent?
Is that your intent?
The amount of wealth that you can create over your lifetime. And when you ask people that question, they're like, well, no, of course not.
Right. Yeah.
Well, then why are you designing a policy you can only fund for 10 years?
Yeah. Right. And I'm not saying a 10 pay doesn't have its place, but I hear about these designs and people calling them IDC where they do the RPU at year 10 or I don't remember that. Not that the examples in the book are, hard and fast. You have to stick to the exact design or whatever. But again,
I don't know. I've never written one. I mean, maybe there's a place. I haven't come across that yet.
Yeah, there's probably a place for them, but sure. I think once people see, that's just when it's getting so efficient.
Right.
You know what I mean? It's like, you should keep going.
Yep. Right. We could do 100 different analogies to get that point across, but hopefully that worked.
Yeah.
How How about this one? This is kind of a more philosophical one, but starting with the solution without understanding the problem. So I see this when people come to me and they're like, they saw a video that hyped infinite banking up like, the panacea of all financial problems. And they're like, I got to do this. I want this. Can I get an illustration? Or what company should I do this with? How should the policy be designed? What does the illustration look like? What's the interest rate on the loans? What's the dividend rate? Like that goes back to that overall point we made at the beginning is that's all the scene.
That's the scene.
What you need is the unseen.
That's
like,
right.
What does Nelson say about the problem and the solution? Like if you know what the problem is,
the solution becomes you'll know the solution, right? It becomes fairly obvious.
And if you don't know what the problem is, you can find a solution and it won't even matter because it'll mean nothing to you.
That's right. And I like starting there. I like starting with the problem, and I'm glad he has a piece of the book that is labeled that, the problem, right? Mm-hmm. I think that it's that people are stuck in that paradigm, right? That they're comparing everything in the financial space against some sort of rate of return or whatever. And it's just, that is the wrong approach angle, right? We're both pilots, right? That's the wrong approach angle to take of IBC. You need to know what's going on before you can know what to do. That's why we encourage everybody to, in fact, this guy he's like, I've read the book twice now. I'm like, perfect. Yeah. Like, excellent, man. Those are the people that will quickly understand what's going on because they remember what Nelson said in the book. They've underlined it. They've, written their own notes. And that's so important to moving forward in this, because if you really don't understand what's going on, you're going to get the amnesia 6 months down the road with Uncle Bob's like, hey, why are you paying so much premium? That's so stupid. You should be, dollar cost averaging in mutual funds.
Yeah.
Which is terrible advice, by the way.
That voice sounds like National Lampoon's. Like, hey, Grizz,
hey, Grizz, go out and get my stogie. You couldn't hear a dump truck driving through a nitroglycerin plant.
That's class. I'm going to be watching that movie on Thanksgiving.
Oh, it's the best. It's the best movie. Yeah.
It never gets old.
Yeah.
Okay. How about one more? One more of this one is continuing with a policy that's not designed properly. Now, let me caveat that. Does that mean if you have just a whole life policy that's all base, or you have a 10 pay or 20 pay or something like that, should you go cancel that? No, that is not what we're saying. I think what I see here is when people have, say, like an IUL policy, they've had it for a few years, and it's not even close to being efficient. In fact, it's going to take another, say, 10 or 15 years to get to the point where their cash value is going to grow by the amount of premium they pay every year.
Yeah, it might be worse. Well, yeah. I got a guy that, he's 14 years into this thing, and the cash account, it's an IUL, is not quite half of what's been paid in premium. It's awful.
How's that compared to the illustration he received when?
Oh, I'm sure it doesn't look anything like it. I know, it doesn't look anything like it. Oh, so God.
You got to know when to hold them and know when to fold them.
That's right.
So I would have no problem kicking a bad policy to the curb, assuming that person, you can put together something that's more beneficial for them, and they can be insured, and the policy is in place first.
Right.
And then they can make a decision like, do I really want to keep funding that piece of crap, or do I want to redirect those funds to funding this new, a better design that's more efficient, that's going to be able to create a banking system for me right away?
Those things are like worse than a sinking fund, if that's possible. They're almost like they're worse than owning a boat. At least, I know what my boat's going to do for me. I'm going to go down and lower it into the water, turn the key, it's going to start, and I'm going to go out and use it. You don't know what that IUL is going to do.
No, you don't. No, kind of like the weather. Like, it's not up to you. It's really not up to anybody. It is what it is.
Mm-hmm.
Yeah.
Flawed by design. And that, I don't want to make this an IUL discussion, but flawed by design. Just
Yeah.
And I was
But
talking
again,
to a friend of ours, and he's like, Paul, they're all like that.
yeah.
Yeah. And he's seen a lot more than I have. I've only seen a couple, like 3 maybe. And he's like, they're all like that.
Yeah. Um, not, I had I'm working with a guy and he's had some IULs for about 10 years. And he sent his agent an email. All he did was request an in-force illustration. And she sent him back this bullet point list of, if somebody's trying to get you to cancel this, do not do it. You're past the surrender period. I'm like, actually, that's an advantage.
That's an advantage.
To get rid of the policy. There's no surrender charge now.
Right.
Fantastic. And she's like, blah, 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 blah. Like, this policy is perfect, blah, blah, blah. And I'm like, oh. It's like, all I do is ask for an in-force illustration. She's freaking out. This must happen more often than not, where people are like, hey, this thing is not performing like you said it would. 10 years later, not even close.
Yeah, and a lot of people now are starting to say, hey, my IUL has these minimum guarantees. And I'm like, well, do they go past age 100? I don't know. I was like, well, go ask. You might want to find that out because you might live past 100.
And can they change those guarantees on you? I mean, can they change that minimum floor and max, oh, you can get all the way up to 10%. Oh, we're going to change that now to only 8%.
Right. Well, there's only a few things going on in the equation, right? If there's a few people involved, there's the policy owner, the insured, the beneficiary, and the company administering the policy. I guarantee you that company is profitable.
Sure.
And they're not profitable because they are charitable and give things away for free that don't make any sense. I guarantee you that IUL is extremely profitable. Yeah. And just like term is extremely, you look at the company that I think it's Prudential that does SGLI. Yeah. Great. Old company, big, whatever, fine. How much premium do they collect from the military every month?
Right. I know, man.
40 million?
Jeez. Wow.
A month?
Think of the banking capabilities on pulling in 40 million a month. What kind of lines of credit that company can get from a bank? That's unreal sure, to think about.
Yeah. Or how much do they lend to banks?
Yeah. I think to boil it down, whoever's in the most advantageous position is the one who's taking the least amount of risk. And in a whole life policy, you've transferred 100% of the risk to the company.
Yeah.
There's risk in everything you do, but the question you need to ask is, who am I transferring this risk to? And with whole life, you transfer 100% of the risk to the company.
Right.
With, other types like IUL, you're taking a good chunk of that risk yourself.
For sure. You're not transferring as much. Right. And over time, it just gets worse, right? It gets less efficient with time. Like, why would you ever purchase something like that? And it's the way it's sold, though. It's like, oh, you can shrink your death benefits so the premium goes down, and then you can use the cash account to fund the,
Why would I want to shrink my death benefit?
I was like, that doesn't make any sense.
Right.
So again, we said this before. Anyone trying to say that they know IBC and is trying to sell you universal life in any form, run away from them. They have no idea what they're talking about.
Yeah, it's really copyright infringement, honestly.
Yes. Yeah, it really is. Anyway.
Okay.
Not appropriate for IBC.
So we got on to a little soapbox there, but
yeah,
really
sorry.
The last one. Well, why don't we end with something happy? We're a few days away from Thanksgiving at the time of this recording. I know this is going to come out the week after, so hopefully everybody had a wonderful Thanksgiving. I'm hoping the football games were enjoyable, and I'm hoping you didn't stay awake for them all, because that's one of the great parts of Thanksgiving is getting full.
Oh yeah,
on the couch.
I can't wait to do that.
Yeah. Yeah. So what have you been thankful? What are you most thankful for over this last year?
Yeah. Well, it's a few things, I guess. Been healthy. Been going to the chiropractor, fixing the back issues and the neck issues and stuff. So that's been nice. Thankful for the family. My colleagues, my friends, my family, and really we've got a lot of new clients this year, Dave. Both individually and then through the podcast. So I want to thank you for pushing us to we talked about starting a podcast for a while, and then finally, last year you were like, hey, let's do this. I'm like, okay. So it was
this time last year we really started formulating a plan. Yeah.
Yeah. Cause this is episode 42, I think.
Yeah.
Right now. And it's been great. I really enjoy, we touch base every week and multiple times per week, but it's just nice to chat with you every week. And, we have the best clients too, just really, really good people. And I'm really thankful that they're finding it. They're finding the podcast helpful. And, we're going to keep on going. The guys that help produce the podcast for us, great guys, and definitely appreciate all their help as well. So,
we do not produce this ourselves. So
there's no way.
I would never, we would have lasted about 3 episodes.
There's just no way. There's no time to do. I don't have the skill set. So definitely glad we're helping them grow their business as well. Right.
Yep. So, well, cool, man. Yeah. I'm pretty much with you on all those things. Really, man, God's been good to me this year. It's been a big year of changes. So got married. So that's, my biggest thanks of the year is marrying Hannah and expanding our families, by 100%.
Over 100%.
Doubling the size of the family.
Yeah.
And this podcast has really given us a much larger reach. I think we have listeners in Germany, and I haven't checked in a while, but I think I saw one listener in Africa once. So pretty cool. And our business has really expanded to the point that we're, it's a good problem to have where you're like, I'm too busy. I can't handle much more, which is a great problem to have. And it means probably should have started a while ago, bringing on more people to help out and to, work with clients and just build a business. So, yeah.
Yep. You're still trying to find that diamond in the rough assistant, aren't you?
A diamond in the rough, man. He or she is out there. I am working with my brother, so there may be another Beffert in the mix here that people can talk to before too long. So
awesome.
Looking forward to that. It should be a really good 2023. So man.
Yep. Bring us your friends. People often ask us like what they can do for us, and really, if you're our client or you're our listener and you enjoy it, and you know someone that's looking to do IBC, is bring them to to either a practitioner or if you like our content, bring them us, and we'll get them going properly. We don't do IULs. We don't do. We basically do dividend paying whole life that's structured for that individual or that family, and we do convertible term if that's an appropriate product to give them as well. So, but you're gonna have to read. Sorry.
Yep, you do have to read. So,
you gotta read the book.
I'm definitely thankful. It seems like the word is spreading. We're kind of on a hockey stick approach right now with IBC. Like it's quickly spreading like wildfire, and it's about to explode. So it's really great to see that message spread to a lot of people now.
I just want the message to spread properly.
Right. Which, if you're listening to this podcast, congratulations. You found a good source that sticks true, we hope. And we do our best to stick true to Nelson's principles. So, and we have other IBC practitioners keeping us accountable. If we got off track, we know somebody would slap us in the face and say, hey, read the book again.
Might shoot us with birdshot. Who knows?
Might, pull the Dick Cheney on us while out pheasant hunting in South Dakota or something. Yeah.
It's so funny.
Well, all right, man. Well, you have a happy Thanksgiving. And
yeah, you guys too.
Yeah. Thanks, buddy. We'll talk to you soon.
All right. See ya.
All right, see you.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.